Okay, so we'll finish off the pod by talking about what's happened this week in terms of the Bank of England raising the interest rates higher than many analysts and even ourselves thought would happen. And Damien, you're going to kind of look at this and sort of break it down, what it means for people and what we might see in the future.
So the Bank of England hiked the base rate from 4.5% to 5%. It was widely expected it would go from 4.5 to 4.75. Now, inflation has proved stickier than people had expected or the Bank of England had expected, I should say, and it hadn't moved. It stayed the same last month. It didn't drop. So in America, they've seen their inflation rate start to fall, and it's meant that the US Federal Reserve has been able to pause their monetary policy tightening, so raising rates for now at least. But of course, in the UK, we got a very worrying inflation figure the day before the Bank of England Monetary Policy Committee were due to meet to announce or make a decision on what interest rates would be going forward. That was higher than they'd anticipated. It was higher than most analysts had expected. And as a result, they hiked rates more aggressively. So if you think the last interest rate hike was only 0.25, this represented an acceleration in their hikes. So what they're trying to do is trying to control inflation now by going in hard. And the market had already started to ramp up its bet on how high what they call the terminal rate, so the final interest rate, the highest point that the base rate would get to. They had already been ratcheting that up over the last month or so. So we'd gone from where they thought the base rate wouldn't get much above 4%. Well, we obviously were above that, got above that quite quickly. They started to bet it was going to be 5.5%, perhaps that terminal rate. But now, as we make this podcast, the market is predicting that the base rate will get to 6% by the end of this year, early 2024. So that's a significant jump. And so markets obviously reacted. Mortgage rates have been going up anyway, and so we've seen them move up significantly. I mean, if you're looking even at the best fixed rates out there, they've probably jumped in the last month or so by almost 1 percentage point, and that reflects this issue that we've got in the UK with inflation and how the Bank of England can control it. So one thing is, how is the Bank of England trying to control inflation? And this is obviously a bit of economics. I've talked about this analogy in the past, that if you can drive a car, you can understand how monetary policy loosely works. So when you're driving a car and you've got the rev counter going up, the rev counter goes up, you then change up the gears. If you don't, you'll end up overheating the engine and it'll blow up. If you want to use a loose comparison analogy, think of that as the economy. So inflation is the rev counter, your gear stick are the interest rates you can control, and the engine and the sort of speed that you're going along is the economic growth in the UK. So if we get to a point where inflation is picking up, the Bank of England will naturally start to increase interest rates. A bit like as the rev counter keeps going up and you're accelerating away, you keep moving up the gears. Of course, if inflation starts to fall, then to stop the economy stalling, your engine stalling, you change down the gears, i.e. cut interest rates. So now you get how, broadly speaking, monetary policy works. The issue that we've got in the UK now is that we have interest rate hikes, but they are impacting fewer people than they used to. So back in 1989, if you look, because I see a lot of people who may be older writing things like, yeah, well, we had interest rates really high when I was young and they're being hiked. We're in a different world to back then. So first of all, in answer to that question, back then, on average, the typical mortgage was only about 4 times the salary, the average salary. Now it's about 11.5 times. It's about 11 times actually the average salary in the UK, and that's because of just the way the world has moved on. So people are more leveraged; they have bigger mortgages, and so the 6% rates that we could get to will be feeling like the double-digit interest rates that people had back in the 1990s. Where we are now is already a similar level of pain as people experienced back when rates were hiked very aggressively back in the early 90s. The issue and the difference that we've got now is that back then, in 1989, that was when fixed-rate mortgage products entered the UK, so we had them. And so everybody back then was pretty much on a variable rate mortgage. So when the Bank of England moved interest rates, everybody was impacted who had a mortgage. So when they moved them up, everybody was impacted. And what that does is when interest rates go up, we all know we start feeling poorer because our mortgage rates go up. If you're on a variable rate, even if you're on a fixed, when you come to remortgage, eventually they will go up. So you have less money to spend. You start cutting back on things, and that starts to filter into the economy. You stop buying things. People start saving more money. They put more money in their savings account because you get a better rate of return. And also that starts to happen with companies. So they stop borrowing money. Cost of borrowing goes up. So they stop expanding, maybe stop recruiting. And so what happens is you start to get the economy cool down. The problem we got at the moment is back then, everybody was pretty much on a variable rate mortgage. At the moment, when I look at the numbers, this has changed over time. But when I've looked at the latest charts, only about, I would say, it's looking at the chart here, between 10 and 20% of people have a variable rate mortgage. Everybody else is on some kind of fix, between a 2-year fix and a 5-year fix. And so that has a significant impact. What it means is that fewer people are being impacted by the rate hikes that are going on than they were previously. And if you look at the population, so households in the UK, I think it's around about 28 million households. Broadly speaking, it isn't quite this. I've got the numbers in front of me, but just to make it easy for people to understand, about a third of them are owned outright, so there's no mortgage. About a third have a mortgage on them, and then you've got the rest split between private rent and social rent. So people in private rent are seeing their rents go up, we know that. But when you're talking about mortgage increases directly, it's only impacting about a third of the population. And of course, if we're talking about the mortgages that are out there, only about 20% of that third have a variable rate mortgage. And then if you look at the people who are remortgaging in the next year, or since the beginning of last year, it's just over 1 million people. And so the biggest rate hikes are only impacting, it's a number that's around about 50,000 people a month are remortgaging. So what you're seeing is a very small portion of households in the UK who are experiencing the extreme pain of these hikes, and the majority aren't yet. That's very different to if we go back to the 90s, for example. So what we're hoping, or what the Bank of England's kind of hoping, is there enough pain is put on those people, and obviously there's going to be an impact on businesses, as I said, but enough pain is going to be put on to those people to slow down inflation and have that impact on the economy, for us to not have to have high rates for longer. So if I want to put this all in a slightly different way, if you imagine there's a big long conveyor belt that we're all standing on, and at the front of that conveyor belt going towards the sort of abyss, the furnace, like you saw that scene in Toy Story, the people at the front are the people who either are on variable rate mortgages or remortgaging now. And what we're hoping is that as people go along and drop off that into the abyss and into all that pain, is that enough people eventually get to that point and experience that, so the conveyor belt stops when it's our turn to get to the front. That's the world that we're in at the moment, which is why I think we're going to be in a period that interest rates are going to be higher for longer, because it's not going to be until the back end of 2024 when 4.4 million people will have remortgaged. Where we are now, roughly about 2 million people have remortgaged since the start of 2022. And so you can see there's a lot of people still yet to remortgage, but then that's only 4 million households. So higher for longer is likely. When you look at the market where its predicting rates are going to be, like I said, it's going to be 6%. In 2 years' time, the markets are still going to be at 5.1%. Of course, mortgage rates that you can get, the fixed rate deals, will depend on future predictions of where rates are going to go and the availability of funding. But the message is that the mortgage landscape and the backdrop, the economics, isn't particularly favourable at the moment for the UK. And we are also in an environment, people may ask, why is the UK seemingly struggling with inflation more than other countries? And it's a whole combination of things. It's partly because of Brexit. Don't forget, it's also partly because of all the monetary policies that we had in terms of loosening. So things like QE that we've had in the past has been one of the drivers of inflation. We've also had the furlough scheme, and we've had the energy help in the last winter, all of that is extra money that's been fed into the system, which starts to push up inflation. Now, there is obviously another school of thought that the current inflation problem we have, not all of it is driven by simply supply and demand in this country. We are importing a lot of inflation. Of course, what happened with Ukraine, it drove up a lot of inflation. So there are people, and I can understand, there's almost a slightly blunt instrument. I've already described how raising interest rates is a slightly blunter tool than it used to be for the Bank of England, but also the current problem we have isn't going to be solved by the Bank of England, because some of the inflation that we're getting is stuff that's being imported in. Hiking interest rates isn't going to change that supply side problem that we've got, and some of that has become because of the pandemic, and also whether people like to admit it or not. Mark Carney was in the news the other day talking about how Brexit has also been a cause of part of the inflation problem that we've got. So all of that in the round is where we are, and the situation isn't great. Of course, things can change relatively quickly, because obviously if we have a crash, an economic crash, and interestingly markets started to bet that was more likely after the hike the other day, then we would see rates start to come down again, and we've seen that in the past. But you can now understand why there is a pushback about over the government helping people with mortgages. Not only would you only be helping a portion of the population, but you'd also be blunting an already blunter tool that the Bank of England has got. And again, to give you another analogy, what it would be like being in a car with the Bank of England raising rates, and they're trying to put the brakes on, they're trying to slow things down. Meanwhile, the government is putting their foot on the accelerator pedal and sort of screaming for joy, and basically going to cause a crash. So that is where we are with the economics, why things are happening like they are at the moment, why the Bank of England probably did hit that panic button and go up 0.5%. And does it mean that we could see more hikes in the future? I think it is increasingly likely that we will do, but I think we have to wait and see what the inflation data says. So month to month, keep an eye on the economic data, so inflation data. And also, if you are due to remortgage in the next couple of years, do listen to the past podcast episode that I did. I did a past podcast episode, number 382, that was done last year, where I talked about a reality check for mortgages and talked about how to prepare for your mortgage going up in the future. And I used the advice that I gave, I live by that, and it's helped me massively as I'm coming through this mortgage chaos like everybody else is. So go and listen to that. We've linked to it in the show notes as well.
Okay, so that's it. We are done for this week's podcast. If you want to get in touch, you can do so in the usual way. It's Damien at moneytothemasses.com. You can get in touch with me too. It's Andy at moneytothemasses.com. Don't forget, we've got all the other bits and pieces right throughout Money to the Masses. We've got the socials, our YouTube channel, youtube.com/moneytothemasses. Check it out if you haven't. And also the Facebook group as well. It's facebook.com/groups/Money to the Masses.
So please do leave a review, because it will really help the team. It's motivating to the team for all the effort that they put in. So make sure you do that. 5 stars, let us know, and you could get a Money to the Masses mug.
And so that's it. We're done for this week. Damien, all that's left for us to say is until next time.
Until next time.